On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. I hope the new year is treating you kindly. I wanted to kick things off today with 6 predictions for 2026. It's that time of year, isn't it? Us economists, analysts, strategists, we are all dusting off our crystal ball and we are confidently predicting how the year will play out. And usually what happens is within a few short months, markets have made fools of many of us. I am very sceptical of the whole exercise. Trying to predict and forecast financial markets is incredibly difficult for anyone to do with any accuracy or consistency. But having said that, I also find it refreshing when people get off the fence, take a view, and it's a useful exercise to go through to try and put down on paper some of the things you think might happen and why, and just work through that thought process. So here is my contribution to the noise. You're welcome to agree, disagree, send me your thoughts, send me your comments. Record your own episode with what you think is going to happen. I would love to hear it. I expect to be wrong, like most others, and the only question is where I'll be wrong and what degree. But here we go, 6 for 26. Number 1, the OCR hiking cycle will have begun, or at least it will be imminent by the end of this year. Now, the official cash rate was cut from 4.25% at the start of last year to 2.25% at the end of last year. So that's a big fall, 2% down, and that sees it well down from the 15-year high of 5.5% that prevailed in 2023 and 2024. So the OCR, the official cash rate, is now firmly in stimulatory territory, which will take some pressure off borrowers and help the economy recover. All going to plan, this is the bottom right here. It won't go any lower, and the next move, whenever that comes, will be up. The Reserve Bank has been at pains to point out that there is no rush in raising the OCR. However, financial markets see hikes coming over the second half of this year. Now, that might seem a little bit outlandish when we've only just got to 2.25%, we've only just got to the bottom, but if things pick up as expected, then I think at the very least we will be talking about looming hikes again. And we've seen the Reserve Bank change tack more than once, haven't we, in recent years? So why wouldn't they again if conditions change? So that's my first prediction. By the end of this year, if we haven't seen an OCR hike, we will be talking about imminent OCR hikes. Number 2, the local share market, the New Zealand market, will have its best year in 5. Now, if it's not the best year in 5, I'm very confident it will be the second best in 5. Since 2020, the NZX 50 has had 2 down years, 2 where the market rose, but it was only up about 3%. Last year was one of those, and it's had 1 good year, which saw an 11.4% gain. That was the year before last, 2024. So I think we should be able to beat at least 4 of those years, given the setup heading into 2026. You've got borrowing costs that are much lower, business confidence is well up at a multi-decade high, and the economy has dragged itself out of recession. So things are getting better. The labour market will improve, unemployment should come down, and corporate earnings should follow our improving economic fundamentals higher. And with the NZX 50 offering a very reasonable gross dividend yield of about 4%, we should go close to a double-digit total return if we see some modest capital growth from our listed businesses. Now, one caveat, 12 months ago, I would have said this exact same thing, and I would have been dead wrong, wouldn't I? So 2026 hopefully will be different to what we saw in 2025. Just for reference, the 30-year average from the NZX 50 is a return of 8.5% per annum. That includes dividends and obviously share price growth, but it doesn't include imputation credit. So that's number 2. The NZX 50 will have a much better year. Number three, house prices will rise, but only modestly. Now, the only asset class that has been more disappointing in recent years than the local share market has been the local housing market. Prices have been flat for 3 years, and they're still some 15% below their 2021 peak. They're down further if you adjust those for inflation. Property investment is really hard work when there are no capital gains to speak of, because you've still got to pay for all those actual cash costs like insurance, like rates, like maintenance, like the interest bill, and you might be collecting some rent, but it's not going to cover all of those things together. So property investors do rely on prices steadily rising. That should change this year. Sharply lower mortgage rates and improving sentiment should ensure that house prices rise in 2026. So I actually think now is a good time to buy. However, homeowners and particularly investors do need to keep their feet on the ground. In the years leading up to the pandemic, the OCR was below 2%. We're not going to see those levels again anytime soon. Affordability also isn't as good as we would like. It's still low for many people, and you've got the prospect of policy change that's still hanging over us. Remember, there's an election later this year. For context, since 1990, house prices in New Zealand nationally have increased at about 5.5% to 6% annually. So I think homeowners should bank on a growth rate over the next 12 months or so in that 4 to 6% zone. So better than we've seen for the last few years, but still quite modest. That's number three. A better year for house prices, an up year, but keep your feet on the ground. Number four, thinking about share markets and equity markets further afield, I think the US will remain in the driver's seat and will still have a solid year. It's really hard to bet against America in 2026, so I won't do that. This is another prediction that could fall flat. It does worry me that investors are almost universally bullish about current trends remaining in place, and that does make me think maybe things will go the other way. However, America's economic fundamentals still look good. I know unemployment has risen a little bit more than we would like of late, but economic growth is still intact. Inflation is contained, and the Federal Reserve still has room to reduce interest rates further. Now, unless you see a recession on the horizon, and I'm not seeing any major alarm bells in that regard, that is typically a recipe for solid returns, decent growth, moderate inflation, and rate cuts likely to come. We can all point to overheated valuations in places, but prices are far from stratospheric, and this alone is unlikely to cause a market meltdown. Deutsche Bank did a 2026 global market survey, and they asked people what the biggest risks that they saw were for the year ahead. And tech bubble risk towered above everything else. So ironically, that could mean that if something does go wrong, the catalyst could come from elsewhere. Analysts are expecting earnings growth from the S&P 500 of almost 15% over this calendar year, and if that turns out to be correct or close to correct, I personally think we are in for another decent year stateside. So that's number four. The US will remain solid. Number five, the New Zealand dollar will rebound. This is probably a bit of a controversial one because I know there's a lot of strong views out there about currency markets and where the currency deserves to be. The Kiwi dollar is still below its long-term average against all the other major currencies, apart from the Japanese yen. Relative to where it's been historically, it is particularly weak against the US dollar and the euro. Now that has been well deserved because we have had a deep and long recession and other countries have still been going okay. We've also cut our interest rates much more than most have. We've cut the OCR more than they have across the Tasman, more than they have in the UK, and more than they have in the United States. And that means that foreign capital has wanted to go to other places, not here. The money goes where the returns are. And when your returns are low, like they have been in New Zealand, and when your economic prospects look a little bit mixed, as has been the case here as well, the money has flowed to other parts of the world, and that impacts your currency. Now, our policy settings in terms of the OCR, we are already at the bottom. So we're not going to go any lower. We'll go sideways, and at some point we'll go up again. And in other places, like the US, like hopefully Australia, we should see interest rates come down. So that differential between them and us, that gap should narrow. You add in a more upbeat domestic picture economically, And I think we should be back in the 60s against the greenback by the end of this year, and maybe a little stronger against some other currencies too. So that's number 5. I think you will see some modest growth in the New Zealand dollar. That'll hopefully make the prospects of a holiday look better because it'll be a bit cheaper to go overseas by next summer. Number 6, and if we're talking about financial market predictions being a mug's game, you'd have to be even more foolish to make political guesses. So here I go. National will scrape back in this year, but only just. We don't know exactly when the election will be held, probably sometime between September and November. You've got to go back 50 years to find the last one-term government. If National got voted out, they would be the first in 5 decades. And that's an outcome that would be completely unheard of in the MMP era as well. Since MMP came into being in the 90s, every government has lasted 9 years, 3 terms, apart from that last Labour government that only got 6 years, and then we turfed them out. So unheard of for anyone to only last 3. However, National and their partners are on shaky ground right now. And if there was an election today, I think they would really struggle to stay in power. Several months can be a long time in politics though, and if the economy does improve over the balance of this year, as we're all hoping for, then I think that puts the incumbents in a stronger position. So my guess, and it is only a guess, is that National will scrape back in near the end of this year. However, I wouldn't count on that being a strong or a conclusive victory. It's already got that feeling that it's going to be a close one, isn't it? So there you go, there you have it. That's my 6 predictions for a year ahead. Hopefully, at least a few of those will still look possible or likely by Easter. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.